You're listening to the Real Estate Runway podcast, powered by QUATTRO Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right, Real Estate Runway family. Today we're going to have Jacob Vanderslice on with VanWest Capital Partners. These guys are top-notch self-storage operators, so I'm excited to have him on the show, talk a little bit about what their firm is seeing out there in the world today, and just what their general investment thesis is between developing new high-end 3-story elevator access self-storage and buying the smaller mom-and-pop single-story storage facilities. So excited to get into that episode. Folks, if you get any value out of the show, pay it forward. Like us on YouTube, subscribe there. If you're on a podcast app, scroll down, leave us that 5-star review, thoughtful comment. It's the only way we grow the show and reach more people just like you. So pay it forward. Don't be selfish. Share the value. Okay. If you want to be on the podcast, I'd love to have a conversation with you. You can apply at thequattroway.com/podcast. It's very easy, and you can go book your episode right from there once you're approved. Beyond that, folks, we're on all the social medias. So we're on TikTok and YouTube at the Real Estate Runway podcast. And we're on LinkedIn, Instagram, and Facebook, and Twitter, actually, at Team Quattro Capital, one word, no special characters, or just visit us at thequattroway.com and click on any partner social media links from right there. We'd love to interact with you wherever you feel comfortable doing so. And folks, we are a full service investment firm in the real estate space. So if you want to see if we can work together, see how we might serve your needs from a cash flow or growth perspective, give us a call, hit us up, thequattroway.com/invest. Let's get to know one another. And without further ado, let's get right into the episode. And here's Jacob. All right. Real Estate Runway family, welcome to another episode of the Real Estate Runway podcast. This is your captain speaking. Today, we're going to have Jacob Vanderslice on the show, a principal with VanWest Partners. We're going to be talking today a little bit about the state of the market, things that his very established firm are seeing in conjunction with what we're seeing. And then we're going to focus on their investment thesis of why they think self-storage, cash flowing self-storage and some development opportunities there is really the best asset to be in right now. So Jacob, welcome to the show. How you doing, brother?
Chad, doing great. Good to be here. And to continue with your aviation theme, I've got to support you. I've got an airplane propeller in the background here. So,
I noticed
right.
that. And so I guess the trick is going to be, do you know what plane that is from right behind you?
I know what kind of prop it is. I got it for my birthday like 6 or 7 years ago. So I don't know what it came off of, but it's a Setsinich propeller. So I know that.
Very nice. Very nice,
Yeah.
brother. Very nice. Let's get into you first. So tell me about yourself, how you got into the real estate world and kind of what made you into the person you are today before we get into what we're seeing today in the world.
Yeah. We're a private equity shop based out of Denver. I was born and raised here. Got a wife and 2 little boys that are 5 and almost 4. So we got a lot going on at home after hours and on weekends. It's been an adventure. I got started in real estate investing back in about 2005, 2006. I was a career firefighter. I had a lot of free time on my hands. I only worked 10 days a month in my early 20s. So I started doing some rentals on the side with one of my buddies, and we scaled that business over time and quit my full-time job. And I've been unemployed in real estate ever since. We got started doing a lot of single family deals all over the country, mainly in Denver. We covered a bunch of different markets, got into some adaptive reuse retail projects, basically converting old warehouses into breweries, restaurants, yoga studios, did some multifamily, some townhome development. And we looked at the storage space for a while. And we like this fact that it's historically downside protected. It's got durable recurring revenue streams. So we did our first deal in 2015. It was more of it wasn't like an intentional pivot to the asset class. It was just like most business pivots, it's try a deal out, see what happens. And it went okay. So we did another one and we kept going from there. We launched our first fund in 19. Our second fund was 21, and we're currently on our third fund. So we got 40 facilities, about 18,000 units, almost 3 million square feet. And now we're storage guys. And I never went to high school thinking I'm going to be a storage guy, but here I am.
That's how it goes. I never went to high school thinking I was going to own a bunch of apartment communities across the country, but here I am. So it's the same kind of thing.
Yeah. Now I was going to be a fighter pilot, but now I'm an office jockey.
We have that in common. That was actually my aspiration and dream as well. I decided to build them instead. I was an engineer in the space for about a decade before leaving to be in real estate. So that's I haven't heard someone else say that before. What deviated your pilot dream, just to get to know you a little bit better?
I got my license in high school. I got my instrument rating in college, and I always thought about going commercial, just never got around to it. I thought about going military. I was talking to our National Guard base many years ago, and I don't have any regrets in life, but if I didn't have one, it's never having fun for the military. So now I just rent junky Cessnas at our local airport, flying in circles and then land again.
Yeah, those are a lot of fun. And I was recently exposed to sailplanes. If you've ever flown one of those, I had the
I
experience of
have
taking
some
one up.
glider time. Those are
Yeah,
magical. Yeah.
those are fun. Like pulling one up to just before the stall. It's the quietest you've ever heard it. And then it gets real noisy. So anyway,
Purest form
I,
of flying out there. Yeah.
yes, I digress. I digress. Thanks for sharing that moment with me, folks. And I'm sorry you had to hear that, but that was a prior dream of both of ours, it sounds like. So let's pivot a little bit, Jacob. With you and VanWest Partners out, so you guys are out in Denver. We are centered out in Tennessee. So we're on two separate sides of the country. But I think we both have our ear to the ground and to the market and to what's going on. So let's have a conversation on what your firm is seeing out there in the world today. And we all know we've been post-inflation, post-COVID. We're now in the reactionary interest rate rising environment. How's that impacting your world, your assets, your capital? Let's just start there and see where this goes.
Yeah. We'll focus on storage, but some of my commentary will transcend asset classes to a degree. We're coming out of an era of extreme irrational exuberance, right? Just buoyant rise in values, historically low cost of capital. If you're doing deals back in 20 and 21, you almost couldn't lose. Debt was so cheap. Values weren't like they are now. And specifically in the self-storage space, and I hate to even talk about the pandemic, but we have to. Specifically in the storage space, that created a massive influx in consumer demand across our portfolio and frankly, everybody else's. We saw record increases in NOI, top line revenue, cap rates were compressing. So it was really just fuel on the fire during those years. And we're seeing a return to normalcy in the last couple of quarters. So consumer demand is lightening up a little bit. It's returning to more kind of pre-pandemic levels. The large REITs are reporting occupancies declining from last year at 96% to about 92% today. Rents nationally are down about 10%. So some of the metrics are down, but you have to acknowledge that those are down from just an extreme peak, an extreme unprecedented peak. So as far as the investment landscape goes, transaction volume is way down. I would say it's down at least 50% through the month of August in 2023 compared to the same period in 2022. Fewer sellers are selling. The sellers that are selling still want prices that were 18 months ago. And buyers are looking at their models and saying, dude, I can't pay you a 5 cap when I'm financing it at 7, right? So transaction volume's gone way down. The deals that are trading are sellers that kind of have to sell, or their basis is so low that they can get a good return, even if they're not getting a price they were 12 or 18 months ago. I think it's the remainder of the year into 2024, we're not taking a position of fear, but we're taking a position of extreme caution. You got to be really careful.
Yeah, I think that's really fair. And I would echo that from Quattro's perspective. And I think you were applying all those stats to the self-storage world, echoing that on the multifamily housing side. Yes, transactions are massively down. Rent isn't really down in our asset class. It's not growing at double-digit organic numbers, which was like, as you said, you couldn't lose with that. But we all knew that had to come to an end. So we're back to moderate growth. Occupancy is definitely down a point or two, which I think is normal as household formation pulls in a little bit. But I'm curious to understand. So you said consumer demand. Are you seeing that the consumer is not as strong as they once were? Is that what's causing consumer demand to pull down on their usage of storage, or they somehow magically have more space now, or just cramming it in their closet? Because my perspective on storage is people get it because they're out of space and they can't afford enough space at home to keep their junk. So they go put it in the storage unit. So what do you think the dynamic is that is impacting the consumer there?
I think a lot of the demand that happened in 2020 through 2022 was, one example is people cleaning out their third bedroom. They're working from home. They want to free up some office space. They put their bed and their furniture in a storage unit. A lot of these folks are now going back to work, right? Elon, no work from home. He's not the only company. A lot of them are shifting gears there because people are more productive being around people to a degree versus just being siloed on Zoom in your basement all day. So I think that's been part of the reason for reduction in demand. There were a lot of people relocating during COVID too. I'm working from home. I can live in a rural location now versus in the city, get away from some of the crime and pollution and density. I need a storage unit while I move. I think those are some of the demand drivers, but the asset class is unique. I'm sure there's plenty of pain points out there ahead that we're not thinking about, but typically when there's a economic softening, people are downsizing their homes, they're maybe losing their jobs, getting divorced, whatever the case might be. Kind of economic mobility, both up and down, drives storage demand. So if you're going down the economic ladder, you might need a storage unit. And if you're going up and you've got more disposable income, you're buying more stuff, you also might need a storage unit. So it's historically pretty resilient, but we'll see how the next few quarters play out.
Yeah, that's good feedback. And so let's pivot to what you guys are doing operationally a little bit. You mentioned you're on Fund 3, which means you work some of the bugs out of the fund world, and that we always improve Fund 2 and 3 over 1. And you're doing some value add, you're doing some development. So what is your general strategy? Like from your firm's perspective, what is your value proposition when you go buy a storage facility? Are you primarily building from ground up and focusing on that A-class product where you can really have a good management company come in like a CubeSmart or someone like that? Or are you focusing on buying the single level mom and pop stuff and really improving the mom and pop operations and running as a portfolio? Tell me a little bit more about your thesis and how you guys are generating returns in this world.
Yeah, we've got two different verticals going right now. We've got ground up development projects and we've got value add acquisitions. On the value add acquisition front, exactly like you said, we're targeting ownership groups that maybe own the facility for a while. It's not their primary line of business. In self-storage, the industry, even though it's consolidating, over 70% of the facilities in the US are still owned by onesie, twosie ownership groups. They lack money for capital improvements. They don't have efficient revenue management practices. And in many cases, they don't have a website. So you can't lease a unit online or make your payment online. So our value proposition on these kind of mom and pop facilities is we'll buy deals that are undermanaged, above market expense loads, below market rents. And we'll add value first with capital improvements, rebranding the facility to our in-house management platform, which is called Clear Home Self-Storage. And then capital improvements are a fairly small component of our value creation strategy. Most of it's just managing these more effectively, implementing ancillary revenue streams like tenant insurance, late fees, administrative fees, bringing below market customers up to market rents, and obviously growing physical occupancy. So we might buy a deal at a 5 cap, for example, on trailing financials, but we'll endeavor to stabilize that to an 8 cap by year 3. Our development program is pretty different. We're doing development deals outside our fund. And these development deals, we're targeting markets with very high barriers to entry. So markets that have a long entitlement process, unfriendly municipal environments from a government perspective. They don't like self-storage development. It's tough to get a project approved. And our thesis on these, and these are the Class A multi-story climate control elevator access facilities. And our thesis on market selection really is it's going to be very difficult for another developer or operator to replicate that product anytime soon because land's not zoned for it. It takes you 2 years to get through the city. A lot of people don't have the time or the stomach for that. And access to capital is diminished quite a bit. It's tougher to raise equity. Bank debt is obviously a lot more expensive than it used to be, especially on the development front. So yeah, the value add acquisition, they're just undermanaged, undercapitalized facilities, and development generally is in higher barrier to entry somewhat.
Yeah, that makes a lot of sense. So you're going against the herd a little bit, right? There's a lot of, I know there is a lot of development going on in some of the, we'll say unlandlocked areas where they're very, very much supportive of this asset class, but by going against the grain, you're really servicing a population where there's no competition coming in anytime soon. That's interesting.
Yeah, and that's the general risk in storage is new competition. That risk, if you're buying a value add deal, is a little bit lower because if you buy it cheap enough, you can keep your rents lower than a new competitor with a higher cost basis who might build something new. But development, unforeseen competition is a major risk. If you are in a submarket where a bunch of operators are delivering facilities at the same time in a 3 and 5 mile trade radius, your lease up's going to suffer, your occupancy is going to be lower, your revenue is going to be lower. So that's something we try to watch for very carefully. We can't mitigate that risk entirely, but if you focus in markets that's tough to replicate that same product type, you're going to be a little bit safer.
Fantastic, Jacob. So let's serve the investor a little bit for a second. So let's say we have some listeners here who are considering putting some capital into a self-storage, whether it be a development or a value add project. What are some of the questions they should be asking, the things they should be looking for to tell, okay, this is a good self-storage acquisition and investment opportunity from one that may not be uncovering all the stones? How do you help that investor mitigate risk as the expert in the field?
Yeah, it depends on if you're buying a deal yourself or if you're investing in like a private fund or syndication. If you're looking to buy your own storage facility, one of the first things you want to look at are supply ratios. So you want to understand whether that market is undersupplied or oversupplied or balanced. Nationally, there's about 8 square feet per capita of storage. And some markets can sustain higher supply ratios than that because their rents are lower and more of the consumer base can afford to store. Other markets are a lot more supply sensitive because their rates are so high. Like Seattle, for example, rates are $2.50 per square foot per month. Very expensive. But in Colorado Springs, for example, south of Denver, rates are more like $1.25 or $1.50. So those lower rent markets can support more supply than the higher rent markets. So understanding kind of your tipping point on being oversupplied in a market you're targeting is important. But equally as important is what are the comparable rents doing as it relates to the deal that you might be buying. So if you're buying a deal that has a 10 by 10 leasing for a dollar a foot per month, and there's a lot of 10 by 10s in the market that are leasing for $1.30, you might have some revenue upside to be able to push those rents up on your existing customers, but also on new leases. Really, those are the nuts and bolts, supply ratios and understanding rents. Beyond that, your metrics transcend real estate. Is it a good location? Are the demographics good? Is there wage growth, income growth? Is there low unemployment? Is it a market that people are moving into or moving out of on a net basis? Just like everything else, single family, multifamily, industrial, is a location good? And is there a population to support a good revenue stream on that asset?
Yeah, that makes perfect sense. And so just boiling it back down simply for the investor who might be looking to come into a fund, for example, as I know, if you're a self-storage operator, you already know this stuff, right? But if you're considering where to put passive income, so maybe some sort of a fund or a private offering, what are some of the benefits that self-storage provides? And you can talk separately on a development versus a value add if you prefer. But what are some of the benefits that that asset class provides over, let's say, the other, not things that transcend all real estate investing, but over at office or multifamily or retail or something of that sort?
Yeah, I'll touch on storage, but if you're considering investing in a private syndication or fund, I think whether you know it or you're not, you're investing in the sponsor more than you are the actual asset class. So getting to know the sponsor, understanding their track record, are they transparent? Is their reporting robust? Are they hiding anything from you? Understanding all that about a potential partner is really important because you're going to be partners with them for better or for worse for a long time. So whether it's storage, multifamily, or something else, you want a partner that's going to be able to navigate some choppy waters that are no doubt coming up here pretty soon. As it relates to storage, though, you want someone who, in my opinion, is self-managing their portfolio. We used to outsource our management to the REITs. Now, I'm not saying that we're American heroes here. I'm just saying how we've done it. We used to outsource our management to the REITs, and we found over time that, lo and behold, not a big shocker, but third parties don't care about your deal as much as you. We found their expense loads were bloated. There's a lot of ancillary revenue streams that the national REITs keep. They don't share with third party owners. So we started self-managing. And again, whether it's storage or something else, so much of the value creation in commercial real estate investing is about controlling expenses and growing top line revenue, which equates to net operating income growth. And you want somebody who's in control of that versus, in my opinion, waiting for a third party property manager to give a sponsor a report. They forward the report to investors. If it's not going well, they can't do much about it other than just park at the property net. So I think somebody who's an owner operator in all asset classes is an important box to check when you're making your investment selection criteria.
Nectar understands that raising capital is labor and time intensive, and we exist to solve that problem for you. Nectar provides fast, flexible, cash flow-based financing for experienced rental owners and operators. Whether you need cash for acquiring properties, portfolios, or you simply need it for ROI-generating renovations or expansion of staff, Nectar has your back. Grab your 12-month P&L with debt service and click the link in the show notes below to apply today.
So you just gave me a rabbit hole to go down, so I hope you don't mind me doing that. But I hear it's like you're in one of two camps. It is manage yourself or manage the heck out of the third-party manager if you don't want to insource it. And I think it depends on your portfolio footprint, if you're aggregated versus spread out. There's all that stuff. I hear people tell me they self-manage, and then I've bought properties from them before, and they're not doing it well. So some do it great, some do it not so great. So what, from your perspective, that when you decided to approach that task and said, you know what, we're just going to do this ourselves. And I think it's probably more so common in your space because there's just not near as many management companies out there that are up to the task, especially at the institutional level. What are the things you figured out you had to get right? And how did you make sure that your company could effectively manage and be better than anybody else out there?
Well, I'll tell you a quick story, but to be clear, property management's difficult. And I don't want to say we're
Agreed.
good at it,
Thankless.
but we get less stupid at management every quarter, right? We get a little bit less and less stupid. So we don't know what to do, but we know what not to do. So years ago, I mentioned we had outsourced our management to the REITs. And as we learned the business over time, we had never done self-storage leading up to 2015. So it was a learning curve for us. And we realized over time that some of the REITs just weren't listening to our opinion. Like our rents are too low. We're too full. We're at 98% physical occupancy on this deal. Why are we raising rates? And the response we would get is the algorithm says we shouldn't. We're leasing units for $1.20. Market rates are $1.40 and we're full. We got to raise rates. So over time, we, to a degree, got fed up with it. And we were forming our own management platform on some smaller deals outside these bigger ones. And we took over this portfolio in Wisconsin a couple of years ago, 3 years ago. And in the first year, we grew net operating income by about 40% compared to the prior year. We had some market tailwinds there, but we didn't do that because we were especially smart. We just paid attention to the numbers. We did little things like we rebid our landscaping and snow removal contract. We were paying $75,000 a year across the portfolio to a third-party vendor. We got a new one and some local guy who did it for 30. And if you put a cap rate on that delta, you've created a lot of value. So really, I think the key to management is just paying attention to the numbers, caring about the small expense line items, and caring about the small ancillary revenue streams. So we'll sell insurance to our customer base and we'll make about $10 a month on it. And you wouldn't think that moves the needle much, but if you amortize that across thousands of units, you annualize, that's a meaningful value creation on a cap rate basis and a net cash flow perspective. So I think so much about management is just paying attention and having a good team to pay attention.
I appreciate you walking through that detail. And you're right. At some point, then this is whether you're managing yourself or just asset managing folks, you should be paying attention to the minute detail in the expenses and income management. Because at the end of the day, it's how you're valued. It doesn't take much to really whack the NOI. But you mentioned the REITs were managing you before. So go into that a little bit. In the self-storage space, you were working with the big players with the national algorithms and things of that sort.
Some of the bigger REITs now, the largest more recently, there was a merger between Life Storage and Extra Space. And Public Storage was number one, but they leapfrogged Public in terms of market capitalization after that merger happened. So there's been a lot of consolidation in the industry, but some of the bigger ones are Extra Space, Life Storage, Public Storage, CubeSmart's a big one. And all of them do a fair amount of third-party management. And that's a line of business they've been trying to augment over the last, call it 5 years. A number of them who weren't third-party managing before are now doing third-party management. It's a profit center for them too. So they're not taking any of the investment risk and they're getting the fee income stream. And a few of them keep a large percentage of the tenant insurance revenue. And I mentioned that $10 a month example earlier, but it's not a small piece of our top line revenue. So in our portfolio year to date, tenant insurance, late fees, administrative fees, and kind of merchandise sales comprise 10% of our top line revenue. And if you're giving up a third to a half of that, that's a meaningful amount of money, especially once again, when you slap a cap rate on.
Absolutely. Well, thanks for going into that detail, Jacob. So before we conclude the show, let's go into a couple of questions that we ask every guest on the show. Are you ready?
I'm good to go.
All right. Question number one, Jacob, what is your superpower in life or business and how does it serve you?
I would say two things. I'm definitely a big picture guy and a forest to the trees type guy. I'm not good at detail. I don't like detail. It slows me down. But when we have a question on like financials or something, I can generally step back and get to the answer when some of my partners are more in the weeds and only seeing the trees and not through the forest. And secondly, I would just say connecting with people. My main role in our shop is capital raising, and we've spent a lot of time developing relationships with our investors on a personal and professional level. I think it's been a component to our success for sure.
I love that. Jacob, let's flip the coin over real quick. What's your biggest failure or mistake in life or business, and what did you learn from?
We remember our deal failures like they were yesterday, and our home runs we chalk up to luck, market timing, right place, right time. a couple deals that come to mind that were just epic failures. Well, we once built the house out of shipping containers and ended up taking twice as long and costing twice as much as it would have if we built it. And we thought we could turn these things out in an assembly line. And really all I learned from that was don't build a house out of shipping containers. Stay in your lane and stay focused. We've had some deals that have underperformed over the years, but I guess the big thing I've learned going through multiple market cycles is the model always lies. The model will tell you whatever you want it to, and the deal never goes like the model says it will. It either goes better or it goes worse. Hopefully more often than not, we're wrong in the right direction, but you can model whatever you want. It's up to you to execute and protect that downside. So be careful of models.
That is probably the best advice I've heard in a while. Look, folks, all models are wrong. Some models are useful, and it doesn't matter how folks, look at ours. It's pretty sophisticated, but I can make that sheet say whatever I want to. At the end of the day, I have to execute on it. You have to execute on it, Jacob. And it's wrong
it's not
day
a deal.
one.
Then increase the revenue and lower the exit cap rate. Suddenly it's a deal, right? You got to be careful what you believe when you fill out that spreadsheet.
That's right. Amen to that. All right. Question number 3. Here at Quattro, we are big on philanthropy. It's one of our 4 pillars after all. I love to give our guests on the show an opportunity to just share their philanthropic heart, where you guys do good while you do well and give back into the world. For your firm, Jacob, what would that be?
Personally, I did Big Brothers, Big Sisters for about 9 years. I had the same little the entire time I was there. And for those of you who have heard of the program and maybe considered exploring it, it's extremely rewarding. It's a great experience. You can make the impact on one person. Sometimes an impact on one person that's deep is better than a small impact on many. And more recently, I joined the hospital foundation board of a local neurorehabilitation hospital here in Denver called Craig. So if you get in a car accident or you have a traumatic brain injury or spinal cord injury, Craig is where you go to get rehabilitated. And the miracles that come out of that place are just extraordinary. So we've thrown the weight of our shop behind Craig. I'm on the board. It's a great organization. If you've got some money laying around, go to the website, look up Craig Hospital and make a donation. They do absolutely amazing things.
Thanks for sharing that, Jacob. And folks, scroll down to whatever modality you're listening to this in. This will be in the show notes for your clicking pleasure. So check it out there and give back alongside Jacob and VanWest Partners. So last one's pretty easy. I hope you can get this one right. Are you ready?
I'll do my best.
What is your best contact information? How can people get a hold of you?
I always love to talk shop about real estate. So folks who email me, jacob@vanwestpartners.com, they can go to our website, vanwestpartners.com, or they can hit me on LinkedIn, Jacob Vanderslice.
All right. Jacob, thank you for coming on the show, providing all this value. Folks, check VanWest Partners out. If you're looking at self-storage, they got a lot of good stuff going on. Beautiful website. I just checked that out earlier today as well. So hope to have you on sometime again soon, and we'll see if our predictions hold at all in this market.
Yeah, they're going to be wrong. We'll
That's
see what
right.
happens. Thanks, Chad.
Do you manage multiple legal entities? Is your data scattered across various unsecure systems? Is your team spending too much time on manual processes? Do you struggle to meet reporting deadlines? Simplify entity management and compliance with Entity Keeper. Entity Keeper helps easily manage entities, build and maintain complex organizational charts, and track filing deadlines, all in one secure, cloud-based platform. And with automated alerts and centralized document storage, you'll stay 2 steps ahead of compliance deadlines. Click the link in the show notes to learn more and book a demo.
Folks, I hope you enjoyed that episode. That was a true pro we just had on here. That company is just spectacular in the self-storage space. So glad we got to have a conversation. Glad you got to have a little bit of a peer into the window that is VanWest Capital Partners. So without further ado, if you got any value out of that show, please like us or subscribe. Leave us that 5-star review, thoughtful comment. It's the only way to pay it forward. Get this value to more people just like yourself. If you'd like to check us out on social media, we are on all the major socials at Team Quattro Capital, one word, no special characters, or YouTube and TikTok at the Real Estate Runway Podcast for your swiping and viewing pleasure. I'd love to interact with you and have you on here to the show. If you have some value to bring to our audience, check us out at thequattroway.com/podcast to apply. And if you want to invest with Team Quattro, we're here for you. Love to have a conversation with you. Check us out at thequattroway.com/invest. This has been another episode of the Real Estate Runway Podcast. Until next time, over and out, friends.
You're listening to the Real Estate Runway Podcast, powered by Quattro Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.